Everybody starting to hopefully see this live stream. Give me just a second. I want to make sure that it's going across my account as well as Mr. Weston Nakamura's account on X, YouTube, and all the various platforms where I can be as annoying as possible on social media. This is a special treat because Weston had sent me an email the other day saying, you're not the only one focusing on the carry trade. He comped me on his Substack. I took a look at some of his posts. We're going to be talking about some of his research. And he's absolutely nailed what's happened the last several trading days here, which is why he's willing to take this call, because I don't think he would otherwise be in the right mindset with his portfolio.
I don't think I'm in the right mindset.
you might be profitable. It's still freaking out. We'll talk about it. For those that are watching this live, I can see your comments and your questions, which means that if you want to engage as we're live, you can put it on X, you can put it on YouTube. I can bring it up. So even though this is not a space, I'm more than happy to bring up questions and interesting thoughts here. This will be an edited podcast under Lead Lag Live. Hopefully the world does not end before I actually get that up and running, because I'd like to time that just right. And please, folks, help me keep this effort going. I do this, as you can tell, at off hours. I'm Eastern Standard Time. It's 10:20 p.m. here. It's a Sunday night. I'm tired. I'm fasting, but I'm still pushing. So please help support that effort. And, of course, support Weston Nakamura here. So with all that said, let's talk about the shit show. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour here is Mr. Weston Nakamura, who, if you haven't seen his stuff, he's got some incredible research and analysis, phenomenal Substack. And he and I have actually talked about the carry trade before, towards the end of last year, as a very likely scenario. He and I think, were both early, but as I emphasized, being early is not wrong, as long as you don't short. That's the key to this stuff, which people don't seemingly understand. So, Weston, for those who are not familiar with you, before we get into the heart of the matter, talk about your background. Who are you? What have you done throughout your career? And what's the mood in Japan right now?
Start with the latter. Mood probably is what 1990, bubble burst might have felt like, I guess. I don't know. Hi. My name's Weston Nakamura from Across the Spread. I do macro research and analysis with an Asia focus that relates to and impacts global macro markets, specifically from more of the DM US equity market investors lens. So when I talk about things like the Bank of Japan, the yen, JGBs and stuff like that, I'm not talking to like JGB investors. None of you are JGB investors, I would assume, and JGB investors probably don't listen to me. Actually, they do. But I'm talking from the point of why this matters to people and is being severely undercovered. And so therein lies risk and or alpha. So that's kind of my niche. I'm also a professional clown, and so oftentimes I'll throw in like what I think is humorous. That's up for, again, the markets to debate. But yeah, that's pretty much what I do. And so I have a Substack, and I also have a YouTube channel as well.
All right, so I want to start with a softball question, which is from YouTube. Did Japan just blow up the world? I mean, what is going on here? I mean, I'm making light of it, similar to, by the way, when I was making light of it with David Lin in August when I first brought up the whole thesis of the reverse carry trade. But I mean, how serious is this? Is what's going on? And we're gonna get into the background of it, but let's just talk about the here and now.
So, you started calling it. I don't know if it was you specifically, but I associate you with the term global margin call, I believe. Yeah. I've been saying the CrowdStrike, JPY is the CrowdStrike of global markets, which is kind of the same thing. But CrowdStrike, for those who don't know, is a very recent sort of event where you have this single point of failure across all like IT systems and like took down airline systems. All like so many things were impacted. JPY is that. The JPY strength is currently that of markets. When you start. You're seeing like risk off now, but at first this was triggered basically on July 11th on CPI day. US CPI comes in soft 8:30 a.m. Eastern time. Then that initial knee-jerk move, a softer CPI would imply Fed rate cuts coming, easier financial conditions, markets up, sort of thing. And so you saw NDX futures actually jump on that print. But then about 13 minutes later, you saw dollar yen go from about 162 handle down to like 157.5 in span of a half an hour. That was a yen intervention. That was a Japan Ministry of Finance intervention, buying of dollars slamming down of USD JPY. And that was also top tick for this kind of, from that NASDAQ all-time high moment, as well as, dollar yen, as well as other various yen crosses. And from then on, we were just kind of down and down and down and down. And that all stems back to patient zero, which is the yen carry trade being unwound, yen strength, yen short covering. This is position exiting, right? And at that point, in the first, like, call it 2 weeks or so, that wasn't, again, it wasn't a risk off event, because you saw the Russell 2000 like outperforming the NASDAQ by 20% or whatever the hell insane number, it was. So, and outperforming, I mean, like, actually rising, not like sinking less. So that wouldn't necessarily be like a risk off in the sense of, obviously they're, like equity, that's an equity index, small cap index that's being bid up. Risk off is what I'm talking about, like kind of what's happening in Japan right now, where it's just indiscriminate, anything that is a stock ticker, I don't care what it is, sell it all type of thing, like, or forced, kind of selling everything. So what started out as an unwind of the carry trade and all that was very systematic, where it was trends that had been existing, prevailing, then reversing. So that's why you get NASDAQ, like, NASDAQ to, or I'm sorry, the Russell 2000 to skyrocket as the NDX is plummeting, because those are, long NASDAQ, short Russell, pairs, if you will, being unwound. But those aren't like, people head diving first, like, head first into nosedive, head first into like long the Russell or something. That's all. That's position exiting and position unwinding. But now you're getting the Russell to plummet and all that, and then you're getting the last 2 days. Friday you have the TOPIX index, the broad-based TOPIX index, to now underperform the NASDAQ for the first time since this July 11th moment. The TOPIX index is a broad-based index with like something like 1,600 stocks, and it's cap weighted. It's much more diverse. It's not as heavily skewed like the SPX is towards like 5 names. You saw that index getting crushed, and then you start seeing, I forgot the Nikkei, and then today you start seeing TOPIX index futures, circuit breaker. You have a JGB futures circuit breaker. You have JGB yields getting crushed. You have MUFG, Mitsubishi UFJ Financial Group, the largest mega bank stock, which had been a huge outperformer, which I'm long, by the way, or I was long, getting absolutely crushed, like down 20% today. And so, what you're seeing is nothing to do with fundamentals per se, but you're now hitting the point of like scrambling around and forcing of positions to unwind, and having certain limit orders and levels just getting triggered one after another, deleveraging and all that. But it really does all stem back to just this shorting of the yen, carry trade, being long Mex peso, being long USD JPY, AUD JPY, whatever it is, that often correlate with these other risk assets.
Right. It's a literal margin call mechanically. This was always the thing that I was arguing, and I always argue that would be the spark for a credit event, because that does at some point translate to higher volatility, as we're seeing, and then higher volatility translates into credit spreads widening, which we're going to touch on too. But let's take a step back. Let's talk about what exactly the carry trade is. I am blown away, and I'm very fortunate, and I may say this with complete humility, the number of people that have come out and said, in my case, I was early on it, but I was ahead of everybody else, highlighting this as a risk. I'm very humbled by it, but I don't know if people really fully understand what the carry trade is, despite me explaining it. So in your words, what is the carry trade? Why in the world does it matter?
So let me just say that the reason that I think that that question in and of itself is a very particularly important question is because there is no singular definition of it, and I don't think that people realize that there is no singular definition of it. So
exactly.
If we have to first start with the premise that there are many definitions of it. So when people say like that's not the carry trade, there can all be the carry trade. Okay, so let's just first start there. So there isn't like whatever I say, your definition, yeah, that too. Okay, that doesn't mean mine's wrong. That doesn't mean yours is wrong. There are multiple definitions. Okay, so people have to realize that there are different definitions. Carry trade is the most basically in the kind of this context is borrowing in a in a lower yielding currency, which is default the yen, JPY rates are on the floor even with this rate hike. And and then you take those proceeds and then you invest in a higher yielding currency, which is basically anything else relative to the yen and JPY rates. So and then you capture that kind of the yield spread, the yield differential. And that's essentially what the carry trade is. But then I've also given this example, like how it comes in various different forms. I mean, the carry trades can be something like very conservative strategies for people who are just taking like kind of, nightly income so long as the yield spread remains intact and they get credited to their accounts or they get debited, depending on that yield spread and all that. But it's just like a long-term sort of thing that it's almost like a buying treasuries and leaving it buy and hold until maturity, like long dated, and just get, kind of coupons like paid. It's supposed to be like that kind of sense. It can be anything from that to highly, highly levered and just like 0.5% move or let's say a 5% move in USD JPY, which is what the interventions do, is wipe out in 5 handle increments at a time, can wipe out a 5% nominal yield, yield spread between USD JPY. And then an example I give though is that people don't realize that Warren Buffett has essentially a JPY carry trade as well, so Warren Buffett is famously invested in like 5 of these Japanese trading houses, and those are like very complex mega conglomerates that are in so many different areas and sectors and things like that it's almost impossible to do bottom up like research on. They have like 1,000 subsidiaries, ranging the spectrum of like convenience stores to interest in various other countries, but by and large they're seen as like commodity plays. They rise and fall with commodity prices for the most part. And so what he did was he upped his stake in famously in March or April of 2023, which kicked off the Nikkei upside. But he's opened that position, the equal weight 5 of the largest Japan trading houses, in like August of 2020. And when he did that, Berkshire Hathaway issued yen denominated bonds at very low, if not like, kind of sub 1% coupon. And he used those proceeds to fund his long trading house positions. So what he did was, it's a very brilliant macro trade. He went in August 2020. Warren Buffett went short bonds, long commodities before commodities and interest rates skyrocketed. But in that sense, that's a carry trade that he has on as well. So that could also be defined as a carry trade too. So to answer your question, all of those and then more is what a carry trade is.
So similarly to there's a lot of definitions. There's a lot of different ways of calculating it, right? So there's a question here from Justin on X. How big is the carry trade? I think the BOJ has a balance sheet of 5 trillion. Japanese bank runs. Now I've seen figures that say 20 trillion. Lynn Alden actually sent me a DM saying that number doesn't make sense to her given the way money supply growth works, but it's still a big number regardless. And she and I went back and forth as far as what that could look like. But do we have any sense of how much leverage the BOJ? No. Yeah.
Well, so that's another thing too, because everyone has a different definition, and because a lot of it is, especially in the institutional side, is done, not off balance sheet per se, but it's not done in a sort of, exchange, lit market, if you will. It's done very much OTC. And so it really is impossible to, you could argue about that all you want to, but it's not possible to calculate, period. So let's see. I have something about that though. It was from, I think it was like Nomura MUFG research. Basically, they basically have JPY liabilities as foreign currency in USD. So the carry trade is the highest level since leading into the 2008 financial crisis currently. And it has shot up significantly, kind of broken out, and shot up significantly in 2020, since 2022 really, when JPY started to melt down. But
by the way, there's a lot of interesting research around how the carry trade was one of the reasons that 2008 happened the way that it happened. Right? I mean, I don't know if people really understand that point.
Yeah. That was so the RBA, the Reserve Bank of Australia, printed a research report. You guys can look it up, about Japanese retail investors who had engaged in the carry trade leading up to 2008, which basically trickled into the selling of yen and really AUD JPY was the carry trade of choice. I think that there was maybe like a 4.5% like nominal yield spread differential between Aussie rates and JPY rates, and that the ballooning of that had essentially kind of indirectly or maybe even directly helped fund the long subprime mortgage like instruments that then blew up. And so it was like if I think it was June or July of 2008. So in between Bear Stearns and Lehman meltdown, you saw like a face ripping short cover of the carry trade, and you see AUD plummet like I don't know, like almost by half within like 3 months or so. So it's insane. So that's a and then JPY obviously skyrocketing, and that was a massive carry trade unwind. But I think after July 2008, I think things were fine in markets after that, if I remember correctly. Oh no, they weren't at all.
Yeah, my memory is a little fuzzy on what happened with Lehman Brothers and the lagged effects. It's like this has been the other thing which I've kept on stressing. I even put that post out earlier. I still on Instagram. I said the lagged effects will hit when everybody thinks they never will, right? And that we got to that point. Even just I think anecdotally, I can say that from the financial advisors I've talked to the last several months here and individual investors. I shared this post. I want to get your thoughts on this because the comment now I'm seeing a lot on X is they're going to print money. Here comes the burr, right? It's coming back. Okay. So I put this post out. Here comes the burr, right? The printing of all the more just in response to this. So I put this post out. I want to get your response to this. I said they can't print their way out of this one. This is about a rate hike cycle mismatch with Japan. They'll worsen the dynamic by cutting rates because then the interest rate differential narrows. If that narrows, that should put more upward pressure on the yen. I mean, am I off on that? That the solution isn't as simple?
No, that's not really up for debate. That's pure fact. That's what's happening. You have a monetary policy mismatch, directional mismatch. That's what you're saying, right? The Fed
exactly right.
The Fed is done ripping not the Fed. The world ex Japan is done ripping rates higher, and some are cutting. The Bank of England just cut. And the Fed, so who cares if they do it in September or if they just signal it in July or if they do two and if they do like this, who really cares? The general direction is most likely Fed funds rates aren't going to rip another 5% higher. Probably not. And more likely they will either flatten out and or fall. So that directional reversal would sort of help the yen because that was a big part of why the yen got destroyed versus USD in the first place, starting in 2022 when they started ripping rates higher and BOJ was steadfast in keeping yield curve control and stuff like that just maintained no matter what, unconditionally almost. So now you have that happening, and at the same time you have the Bank of Japan, I guess, on a hiking cycle as far as that's defined in Japan. But yeah, you have once again a continued difference in interest rate policy. Just the polarity has now flipped.
So key to my thesis in August, when I first really brought this up, I said the issue is not so much the yen. The issue is oil priced in yen because oil is denominated in dollars. And as oil rises and the yen weakens for a country that has to import all of its energy, that becomes a real problem from a cost push inflation standpoint. And now you've got the specter of war. Again, who knows, World War III, IV, I don't know what world war we're on now anymore between Iran and Israel. But how does the movement of oil impact anything as it relates to this? Or is this just underway? We can't really kind of expect anything to throw it off.
So in the near term, as in like the immediate term. So by the way, let's kind of clarify for everyone as far as also for ourselves too. We're on different time horizons too. I just so I opened like shorts on Nikkei futures and NDX futures last week. This morning before this, I was scrambling to kind of trim some of those, USDJ, yen futures position, stuff like that. I'm also long MUFG and took a fucking 40% hit in the last 2 days after, and that wiped out the year-to-date gains in 2 days. So my time horizon is very short as relative to yours. You also have a very different role as an ETF manager. So oil prices in the immediate term, I would say just generally speaking, oil prices or otherwise, I wouldn't read too deeply into like current shorter term intraday market movements as what the collective markets are telling us is happening and like extrapolate some giant recession thesis or something like that. Like you're applying shorter term market green and red blinking ticker behaviors and movements that are often tied to like forced position exiting, unwinding that sometimes are triggered by others, other markets or other tickers that have nothing to do with having to liquidate that position, except for the fact that it's owned by the same manager who has to liquidate things. So I wouldn't extrapolate too much, but in the outside of the shorter term trading world that I kind of, personally would live in, oil prices are a key driver. So markets wise, oil prices probably are the key driver of JPY from a markets perspective, just because, commodities markets perspective, just because of the fact that Japan has to import so much oil, which is priced in USD. This is why we have oil or energy subsidies coming in Japan and all that. That's why the Bank of Japan had just released their outlook report, the quarterly outlook report, in which they revised down CPI because of energy subsidies that are coming, but then therefore they had to revise up the next year's year-on-year, base effects. There is sometimes invisible in charts, like clear, oil versus USD JPY alignment that occurs. So yeah, when you have like Middle East conflict and stuff like that, that's not good for the Japanese, on the ground person. And speaking of that too, and kind of outside of markets, I think it was Lynn Alden who recently kind of asked about are people in Japan like actually paying attention to like the actual JPY rate itself? And I think that's not a stupid question at all. That's a fair question, because people, why would they otherwise, right? But my answer to her was, yeah, absolutely they are. Like that is like, this is front page news, like the rate itself. And people who never used to pay attention to it, they know that like the yen, this is a yen getting destroyed environment, and that's a bad thing, not a good thing. Good for exporters, whatever. No. This is a very, very bad thing. And they also know that they're paying a lot more for, especially energy related costs, and to the point where nursing homes are having to going around like room by room every hour to make sure that like their people aren't trying to tough it out by like not having their ACs on and stuff like that. And the Japanese like regular people are trying to figure out what other expenses, personal expenditures to have to cut, because air conditioning and all that is an inevitable rising cost that they have to live with. So yeah, so they know that there's something about, even if they don't know the mechanics, they just know that there's something about like weakening yen and the prices that they have to pay for energy costs. Those are somehow linked, and they're very, very pissed off about it. And then that feeds into, by the way, politics, which is what feeds into what we saw in this latest interest rate policy, this shock rate hike out of the Bank of Japan this past week. So yeah, that's a huge part of it.
And there was, and I believe there still is, a tremendous amount of short speculative positioning against the yen, which is not just the carry trade, but just people were shorting the yen to make money, right? So everyone was so one-sided on this. I've made this point before. The risk is that you get this uncontrollable short squeeze. Now, the yen's been moving pretty aggressively, obviously, especially today. Do you have let's talk about some points where, from your perspective as a trader, you'd say, okay, now it might be enough. Like, what level for the yen are you talking about where you say, okay, I actually want to buy into this now, as far as the equity side, the risk on side?
Okay. Well,
if you want to share your screen, you got some chart you show, yeah.
Yeah. So here's what. So yeah, if you that chart that I had tweeted out a chart earlier about of NDX futures, Nikkei futures, and JPY, very highly correlated. Also of Nvidia as well, because I know that you love that stock so much, and the carry trade as well.
Can you please tell everybody that I'm not crazy? That part of the
carry that's trade sarcasm.
Nvidia. Come on, man. It's like it's the poster child for the carry trade. I don't know why people don't see this. The correlation is clear. The causation is there.
Well yeah. So let me just tell you. Okay, so there's something called NISA accounts, NISA. If you don't know what that is, and if you're a U.S. equity investor and you don't know what Japan NISA is, you need to know what that is. Okay, NISA is it stands for Nippon Investment Savings, whatever the hell it stands for. The UK has a similar scheme, and where you basically get to invest tax-free up to a certain amount. That got revamped that existed for a while, but that got revamped in January 2024. And since then, there have been an enormous amount of new NISA accounts being opened and new assets flooding into those NISA accounts that are investing in USD stocks, S&P 500, NASDAQ 100, and a single stock, which always makes that kind of top 10 list. And that is ticker NVDA. Okay. Now, why are they doing that? The Japanese aren't buying U.S. equities because of American exceptionalism or whatever the hell. They're fleeing the yen is what they're doing, okay? The yen or cash holdings are more than 50% of Japan household assets, okay, of financial assets, more than 50%, okay? So relative, if you want kind of a context, I think U.S. is about like 15%, okay? So Japan is a massive cash hoarding, cash saving society. That's what 30 years of deflation is. That's like literally mattress cash or like stuffed in drawers and things like that. And why are they doing that? Because it's a very risk averse culture. The kind of thinking and is that like, because Japan's government has so much outstanding debt, the Japanese government will not be there for you. This is what NISA is basically admitting, okay? Is openly saying, the government's basically openly saying, the government's not going to be there for you to fulfill its like Social Security, like all that kind of obligations that you paid into. You are on your own. You must build like financial assets. You must build like your cushion, and like it's like a $200,000 USD sort of cushion for retirement is like the figure that's being thrown around. So people were just save cash, and that's great in a deflationary environment. Prices don't go up. People don't even think about this concept of purchasing power. Why should they? Well, when you have, that's fine, but then when you have inflation happening and you have the JPY getting like destroyed, then that safe haven, this supposed safe haven, your 55% of household net worth is now a concentrated long JPY position. So you went from being like in the safe haven to now like a concentrated long, like the worst performing currency for 3 years running now. So people are starting to realize that, and that is probably the most significant thing, is that like, yeah, there are short sellers and speculators and all that who have record size yen short positions on, although those are being pared back and closed out. But the biggest sort of fear, I guess, or the biggest concern I have, and certainly probably the government, although they'll never acknowledge this, is capital flight out of Japan. Because that's not closing of like short positions, that is exiting of a natural long or a holding, right? And if it's coming out of Japan is barely invested as it is, like the Japanese households as it is. They're in single-digit percentage of stocks, but they have flooded into NASDAQ stocks from year to date to record levels, so much so that it like that amount exceeds like the country's sort of balance of payments figure in and of itself. Okay, it's an enormous amount. So if you're wondering why the United States stock market and the NASDAQ has been like skyrocketing or like is up so much against all these very legitimate bear cases or like reasons to be skeptical, it's because of foreign flows, mostly out of Japan, that are doing this. And they're not buying US stocks and Nvidia and stuff like that. They're not doing that because of US related reasons. Even they're doing it because the yen is melting down, and they're just looking for like any non-JPY denominated asset. But because the NISA accounts only allow for like equities, and they don't want to touch the Nikkei index, which is much less sexy and it's at its all-time bubble peaks, the grass is always greener on the SPX side, is what I always say about the Japanese like mentality. And so why not buy NDX? The NASDAQ stocks are like these sexy stocks that are just that they use themselves, Facebook and Meta and Google, Amazon, all that. So they invest in those, and that's why they go up. That's why they just continue to go up and up and up and up. And then another point I'll say too, Michael. Sorry to continue on rambling like this, but
no, dude, I love this. First of all, you're educating me on things, which I appreciate. But it's like you're validating I'm not crazy, and it's like I was clearly wrong in Nvidia, but it's why was I wrong about Nvidia? I didn't expect the carry trade to last as long as it did, but now it's starting to slowly then all of a sudden matter.
Yeah. So the other thing I'll say is that just this concept of people need to also understand that markets, equity markets, well, actually global cross-asset markets that have like liquid futures, but especially equity markets are very, very systematically driven these days. Systematic funds and flows. In other words, they're not human beings. Human beings are not the predominant, daily active market participants.
You're telling me that it's not the anonymous troll accounts with 100,000 bots that are following them, tweeting charts and putting squiggles from their basements while their pet hamsters are sleeping? You're telling me it's not those guys?
I don't know about the pet hamsters part, but yeah, by and large, otherwise, yeah, it's not those guys. Yeah, so like, I think that I look, and I don't know why people don't seem to kind of acknowledge this, but when you see very shallow market breadth in the United States, okay, what is that an indication of? It's an indication of a lack of activity, of actual like human stock picking, fundamental activity, like XYZ company, DCF analysis. This is a great company in the S&P like top 100 or whatever, and therefore let's buy shares. And like the absence of that is what causes like very, very shallow market breadth. But then in addition to that, look at like what happens during earnings season, which I guess we're in the middle of in the US. When you see like double digit, or 20% gaps up and down, after earnings releases in the aftermarket or in the pre-market the next day, off of like relatively in line, maybe a slight miss, maybe a slight beat, but like huge, gaps. What that is that's when you see the active human being, fundamentally based capital that is waiting for results, that gets the results, and they all jump in at the same time simultaneously. And that's why you have these huge swings on an intraday basis. Like I wrote in my Substack, like, is that really, like, is that how, kind of free markets are, efficient markets price things, like in sort of 1/4 or 1/5 of market cap increments at a time? Like, no. So what that is it's very systematically sort of driven markets, and systematic and CTA flows and funds up until like the intervention moment of July 11th at 8:43 a.m. Eastern time. They were set to like short JPY, long NDX, short, Russell 2000, all of those sort of trends that were working out like fantastic. And then they just got blown up. So there is like that part of it, like the systematic part of it. It's not just like they're not all reflections of human beings, and nor are they reflections of human beings opening new positions, new longs or anything like that. A lot of it's just exiting, like existing positions that people have to realize, like that's also price action explanations.
I will say real quick, I put out that post like 2 weeks ago. I said they sucked everybody in with this small cap rotation narrative, just as the carry trade's about to reverse. I mean, it's amazing how the market just did that. It pulled them in just before all this happened. A thought came to me as you were talking about the NISA accounts, and actually Alex Nova, who I haven't chatted with in a while, but Alex, good to see that you're watching this. Put the Wikipedia link to learn about the NISA accounts. With these, with the opportunity set, is the Russell 2000 even available for those investors, or is it just large cap? Because I wonder if that explains some of the differential also between large and small.
Yeah, it's available. Doesn't mean that people are going to buy it.
Yeah, of course. Yeah. Right.
So the biggest, so they like, there's various kind of funds. A lot of them are these like, you could call them ETFs, I guess. They're more or less behave like ETFs. But the funds that get the biggest inflows, like the top 10 of them, are at the very top is like this all country world fund, right? And it's supposed to be, I guess, it's just a mix of DM equities. That is 60% like Microsoft and like the top tech stocks. Okay, so that in itself is that. The rest of them are from like number 2 to 10 are like S&P 500, NASDAQ 100 sort of targeted funds, and then sometimes here and there. Actually, I haven't checked recently. You do get like an India fund, because India is also kind of that's like the non-US sort of EM play out of Japan, because Japan doesn't want to invest in China. Neither does the rest of the world. Neither does China itself. So you get that every now and then. But then, like I said, every now and then you do see a single stock ticker that shows up, and that's NVDA. So That's what they do. And do you think that these people are like, diving into like the earnings and like guidance and listening? They don't want to know what Jensen Wang's saying. It's yeah.
No,
So
and by the way, the vast majority of people on X and social media aren't either. It's not fundamentally driven. It's leverage driven. It always is leverage driven. That's what FOMO is about. Fear of missing out is what creates the desire for leverage.
But fear of missing out. But the thing is, when it comes to NISA, it's not missing out because Japan's used to missing out. There's no fear there. Japan is unique. Japan is so unique like that. It's happy to miss out. Been happy to miss out for 30 years. That's why the Nikkei didn't break its record high from its bubble pop 30 years ago until recently. But so they're fine with missing out and hence sitting in cash. What they're not fine with, therefore, is that cash to start getting burned. Right. And so now it's just not fear of missing out. It's fear of,
just losing your savings. Yeah, it's just loss.
Of their savings. Exactly. Yeah. So, getting decimated. So that's and so it might sound nonsensical to therefore find safety in NVDA shares. First of all, I don't give a fuck what you think. It is what it is. It's a cultural difference of mindset that you have to really understand via taking yourself out of your bubble context and putting yourself in the shoes of somebody else from another different part of the world. And you have to look at it from that perspective. Like this whole concept of American exceptionalism, right? Which I believe in. I truly do believe in that. Because of American exceptionalism means that the rest of the world is therefore going to be flooding into and investing into this exceptionalism that is America. Okay, I don't understand why American exceptionalism equals America only invests in America. Like there are factors that because of these global, flows into USD, US Treasuries, US stock markets, you have to therefore pay attention to what's happening in other parts of the world because something there can cause a pull out or a rush into this exceptional America. And that has nothing, and that may have absolutely nothing to do with America in and of itself. So, there is like that part too. So just to, add on to what you were saying about people who are kind of wearing blinders, there's also like a lack of people who are not acknowledging that like the S&P 500 is not a US asset. It's a global asset class. So are US treasuries, so is the US dollar.
You get a sense that the Bank of Japan is bluffing in terms of getting hawkish, and I'll tell you why I framed it that way. So I put there's a piece on the Substack, my own Substack on the lag report from May 10, where the argument that's being made is that you can't really raise rates in Japan because of the mortgage rate dynamic and housing, right, which also gets decimated with any sort of hiking cycle. I mean, how much more can the Bank of Japan do anyway? And do they even need to if the yen is going through this short squeeze?
Do I think they're bluffing? So what you mean by that is are they gonna hike anymore after this shock hike?
Yeah.
Okay. First, can we just acknowledge that the Bank of Japan last week? Okay, I think again this is gonna go back to the American exceptionalism point. Okay. The least market consequential for this current moment central bank that report or that had their policy release is the fucking Fed, the FOMC, okay? And they're doing of the nothing and the promising of a rate hike in September. What's more important after that, the Bank of England, who actually did cut rates. And that was kind of like a 50-50, like, markets didn't really know which way. But arguably, you could either say the Fed doing nothing and signaling that they're going to do something start cut in September, which is something that's been long priced in and expected and speculated about for like over a year now. Or maybe is it that the Bank of Japan shock lifted rates basically off the zero bound, like via press leaks from 12 hours earlier and then actually executing it and then remaining hawkish, like Governor Ueda remaining hawkish after that. I think that might be kind of much more significant, relatively speaking. Okay, so your question of are they going to maintain this, right? It is very politically driven and politically sort of guided, if you will, right now. Okay, you have to ask, why did the Bank of Japan do this, right? Because the last Bank of Japan meeting, the Bank of Japan was talking about, we are going to trim our JGB bond buying at a rate, we're gonna announce like the details of that, next meeting, which is this past meeting in July. And so they did that. But in the process of doing that, they hold these like bond market group, like investor survey groups, like basically bond market participants, JGB market participants, and they would get feedback from them. And essentially, they designed the policy around that. So when they released how they were going to trim the pace that they were going to trim JGB holdings and all that kind of thing, which was basically going to be about 400 billion yen per quarter, down to 3 trillion yen. So basically half of what it currently is on a monthly basis by the end of, was it fiscal year 2025 or something like that? Okay. So that was not only just priced in already, but that was dictated, or not dictated, but that was already that was guided via bond market investors themselves. So there's no surprise there, and there's no surprise that there's no surprise there. So if the Bank of Japan, whose sole kind of focus right now is clearly the yen, everybody knows this. They know that everybody knows this, and they are for the first time acknowledging, at least publicly, that the yen is a factor. You don't have that lever of the QTing or the lessening of QE of JGB purchases to hit markets on BOJ day anymore. So you have that. So you have like a kind of a hike, a sort of shock hike, and it's not just a hike, by the way. And I know it's only 15 basis points. I know it's only to 0.25 to a quarter percent or 25 basis points. The reason that's significant is because, Michael, I'm sure you remember, but do you remember leading up to the first rate hike off of zero under Janet Yellen in December or whatever 2015, right? How much not just guidance from the Fed, but like the fanfare around and like, oh my God, it's FOMC day, it's lift off of zero day, and like. And it was understandable because, after the financial crisis, rates were like collapsed down to the floor, Fed funds rates, and they were left there for a very long time. So who knows what's going to happen once that kind of lifts up. And then they lifted the rates, and then everyone kind of looked around and was like, did the world blow up? And everything was fine. So in retrospect, it looks a little bit overdone, right? But still, I think that some of that caution was warranted. Well, the Bank of Japan just basically lifted off zero, like in a shock manner. Japan did. As everyone else, as you were saying, is on the verge of like cutting. So that's kind of an insane thing. So why did they do that? Okay. They'll say that Ueda will say that this was a necessary thing because of, we need to get ahead of things like currency dynamics or like, risks of inflation or whatever it may be. But he'll say that like, it's better to be ahead of it than to wait too long and then, rip rates higher or something like that. And then he's also saying, though, like he remained very hawkish, and I don't think that necessarily it's a matter of bluffing or not, because he remained very hawkish. Like people thought, okay, so they shock lifted rates, but then at the conference he's going to just tone it down and give it'll be a net dovish rate hike. It was not a dovish rate hike. He was saying like, by the way, like because somebody asked him, what about this 50 basis point ceiling? Right, because that's kind of this perception that there's a 50 basis point ceiling for BOJ rate hikes, and he's like, there's no such 50 basis point ceiling. So he kind of dispelled that. Now, whether or not that's true, we'll find out real time. But he did explicitly say no 50 basis point ceiling. And furthermore, he's saying like, as long as like the economy and like the data performs in line with the outlook, right, not exceeding the outlook, in line with the outlook, we will continue to raise interest rates. Okay, so that could be, I don't know, up to 1%, 1.5% on the BOJ policy rate, for which they've just now brought up to 25 basis points. So now they can move in a normalized 25 basis point increment at a time. So if you say like 25 basis points every 3 months or so, you can get to like a 1%, within the year's time. That seems to be like what they're kind of laying out. And I think that it's not the yen had already been crushed down 10 handles at that point. So it's not necessarily, at least perception-wise, for the yen. I think that they are really trying to do that. I could also argue too, though, however, that because the yen got crushed down, that's why they were able to do it. Because if they're doing it with dollar yen pressed up at 162, then it'll be like, oh, now you're actually using monetary policy to affect interest, affect currency rates. Now that it's off of that, but it's still very, very high USD JPY. That's why they could, so there's a bunch of ways to do that, but I don't think that they're like bluffing per se, but I don't think it's not a bluff or not. I think that they've actually truly lost their whatever shred of independence that they had left at this meeting.
The counter that I often see is Japan wants inflation, so why would they try to squash it now? I mean, let's talk about that, because that is the thing. It's like they've wanted inflation, and now they're starting to hike rates, and it's like, all right, well, you're gonna hike rates, you're gonna stop the inflation,
right? But Japan's inflation is externally imported inflation by way
oil.
of, like, say, energy, and the yen. So the Bank of Japan is in the business of, like, of not currency management, but certainly currency considerations. And the thing is that if Japan, so if Japan is like, sorry, like, I'm getting market notifications like crazy. If Japan is raising their rates and all that, and they're doing it because of inflation, as they say, it's nonsense. Because take yield curve control, for example. Yield curve control had existed since September of 2016. And so when the Bank of Japan shock lifted yield curve control bans under Governor Kuroda in December of 2022, okay, people were saying, oh, that's the Bank of Japan, like, finally reacting to CPI raising, above target of 2% in Japan. And so therefore, like, now that inflation has finally reached Japan, yield curve control is being, like, unwound and all that kind of thing. Yield curve control had nothing to do with Japan's inflation. Like, it was in place for years, over a decade before that. There was no inflation that was generated out of Japan as a result of that. Japan inflation was a result of global inflation that was occurring, not because of yield curve control. So what the hell would the removing of yield curve control caps, or like the raising of them, what the hell would that have any impact on the mitigating of inflation that it didn't cause in the first place? And I would say the same thing about, like, about the short-term policy rate. There is the mortgage thing, but according to Governor Kuroda, or Governor Ueda, he said that with floating rate mortgages and all that, because they reset every 5 years, that in that time frame, essentially what he's saying is that in that time frame, the policy mix will outweigh, like, the growth in real wages and all that will offset any sort of increased mortgage expenses and all that. So he basically not brushed it off, but he acknowledged it, but with a kind of a very nonsense answer. And yeah, so that's where that stands. But yeah, inflation in Japan is not it is kind of a zero sum from the Japanese perspective, like, because if energy inflation is occurring, you're going to spend less on other things, and you're going to choose to, not because you have to, but because things are going up. People are not chasing prices higher because things are going up. People are going to save more because prices are going up. That's how it works in Japan, mentality-wise.
I love this point, which is obviously very accurate. Japan's debt to GDP ratio is like 280%. Won't rate hikes blow them up?
No. Yeah, yes and no.
The government owns their own bonds, right? So it's not simple.
What does blow them up mean? And no, they won't, because why would they blow up that on themselves? Because they own, because they've cornered the JGB market. And if they do, they're going to blow it up on the mostly on that which owns JGBs, which is mostly the Bank of Japan. But at the same time, you're starting to see, like, kind of, relatively speaking, fiscal, like, prudence. I'm very hesitant to say that, but out of Japan, but relative to how they have been before, they are starting to acknowledge, like, higher interest rates means, like, the cost of issuing JGBs has gone up like 4 or 5-fold within the space of a year and all that. And they're trying to they always try to aim for, like, balancing the budget and all that kind of thing. But I think that as it relates to government debt, currently the Bank of Japan is trying to unwind or to lessen the amount of JGB holdings that they have. And it sounds like a lot, right? When you say, like, okay, they're currently buying about 600 billion yen, 6 trillion yen worth of JGBs per month, and they're going to try to bring that down to 3 trillion yen in a very laid out, specific manner. within, in a gradual and predictable manner within the next like year or so. And so that's a minus 50%, drop. That sounds like a lot. But what that means is that that's lower. That's like something like a 6 or minus 7% less of JGB holdings on the balance sheet is all it is. So like it might sound like a drastic measure, but it's this. The Bank of Japan is still the player, the necessary player, and creditor to Japan. And so I don't think it's going to blow anything up in terms of like Japan default or anything like that, because they could control both levers, the fiscal, the issuing, as well as the buying of JGBs, as well as a setting of where the JGB yields could be, via these fixed rate operations where they're bid for unlimited at yield level X, which they got rid of, but they could always reintroduce, as they say in their latest meeting. So no, I think that like what I always say is Japan is this sustainable? No, it's not sustainable. Okay. Is it more sustainable than we think? This like, supporting of the JGB and JPY markets simultaneously. Is that sustainable? No. Is it more sustainable than we think? Yeah. It can go on longer than we think. And that's why they are widow makers. That's why there's a widow maker trade, right? Because it's not sustainable, people put that trade on. Because the Bank of Japan and the Ministry of Finance can carry this on for longer than people's time horizon, that's why they get blown up. So that's the answer. Like if you're asking from a trading perspective, is there going to be a blow up? No, your portfolio is going to blow up. Is there going to, in the longer term, like history textbook sort of context? Yeah, this is not sustainable.
So we only got about 10 minutes, but speaking about time frames and being a trader, I am curious to hear your thoughts on at least very short term, how you think this plays out. Now, I myself have said to a lot of people's surprises, I think that given the fact that everybody seemingly now is on this reverse carry trade, my contrarian antennas go up. I was looking at my analytics on X, right? And I had my second biggest impression day, like 5.3 million impressions in a single day, as everyone started realizing the reverse carry trade may actually be here. The last time I had something that high was when I was peak bearish at the end of October and Black Monday was trending. And that entering November ended up being the low. So let's do a little bit of contrarian thought process here. Short term, right? Short term. Is there a chance that everyone now is so bearish suddenly that maybe we have some kind of a rip before I'm saying a bigger main event comes? And I'm just talking like maybe for like a week, not like some multi-month period.
What do you mean by bigger main event? This
meaning
like look at Japan, like global markets right now. It seems like a pretty big main event.
Oh yeah, no. But I guess where I'm going with that, where the S&P, for example, would round trip and give back all of its gains for the year, as an example.
Yeah, potentially.
You see a move higher first before that.
Well, I would say. So I don't know levels wise, but I would think that. So again, in the context of like just Japan, or like flows into the SPX via like these NISA accounts and all that. So the TOPIX index, like if you're getting 99% of the TOPIX index like names getting sold off indiscriminately and like down to official correction territory, then to like bear market territory within like 2 days and all that kind of stuff. Not the Japan, investors are invested, of course, in Japan equities, but I think that when they see things like that, that might pause the kind of the NISA, flows. But at the same time, and you're also getting JPY strength, but at the same time, we're talking JPY strength, but still at like a 140, 150 handle JPY is still extremely high. I was laughed at when I said like USD JPY 148, and I put out like this video of me like dancing outside the Bank of Japan, like with a dollar yen 148 hand. And well, we were well past that. So I think that the mentality has actually shifted, that Japan needs to, the Japanese households that hold 7 trillion USD worth of cash of dry powder that is obviously not in USD, it's JPY worth of USD. That needs to be kind of allocated still, regardless. And so I think that you might get this might actually cause it's not going to, it might pause like NISA flows for like a week to a month, but I think that eventually you're going to get that like back in, and it's going to come back in like in rapid manner. And that might push up the systematically driven active capital absent indices in the US at the expense of JPY selling. So I think that because of this, we might actually get an outperformance of SPX versus Japan equities, which was not the case over the last year and a half or so, based on those flows. Because again, people, if you're thinking about it from, should I buy the S&P 500 based on like earnings, based on the Fed, based on things related to the United States? Probably not, and that's why you're going to sit out, and that's why that absent flow is going to allow for other flows to magnify their impact. And what are those other flows? Those other flows are things that are flowing into U.S. equities that have nothing to do with the United States or elections or anything like that. They're fleeing a shithole currency. So I think that that's a very high sort of possibility that because of what's happening right now, especially with Japan relative to the U.S., and a structural weakness of the yen that may see a short-term short cover from levered funds, you're going to get a resumption of dollar yen upside, and along with that comes the resumption of SPX inflows on light value, but price level wise higher. Yeah.
So only a few minutes left, but a really important question, which somebody asked, I'm going to bring it up here. Is now a good time to go vacation in Japan? Any thoughts on that, given the currency?
I mean, I don't know where you've been for the last like year and a half or so. It's flooded with tourists. So yeah, is now a good time? Yeah, it's been a good time. I don't know if now is because now like there's so many people. It's also really fucking hot here too. But yeah. I mean, what you know, the country's not been on like a 30% sale rack for the last 2 years. So I certainly would. But is it a good time for JPY people to vacation somewhere else? No, absolutely not.
Let's talk about your Substack for those that are listening. I appreciate those that are watching this late live. I see we have like 27,000 people live streaming this as we're chatting here. Talk about the Substack, acrossthespread.substack.com.
Yeah, so for those of you who have followed me before, from my days as global markets editor at Real Vision to Blockworks Market Depth podcast to current, so I've just kind of reintroduced, I suppose, video content. I'm kind of in the stage of experimenting different types of content, of incorporating both video and written content. So mostly doing written content. So what I do is I try to give broader picture themes of things that are not being talked about, that are impacting or are very consequential to markets that you care about. Again, U.S. equities, U.S. treasuries, stuff like that, global like DM indices and currencies and stuff like that. And I publish, mostly written articles, but, incorporating video and all that too, right? But what I will say is this. This is not like me patting myself on the back or like anything of that nature, okay? There is so much, like, I'm going to say, call it obsession over the Fed and stuff like that. The Fed, the United States, like, Treasury Department and all that, yeah, those are the most influential and the most powerful financial, markets and institution, government bodies and authorities in the world, period. I'm not disputing any of that, okay? But that doesn't mean that they're the only thing to pay attention to, okay? And so there's
and sorry, not to interrupt, but
yeah.
And the Fed is a follower. I've made that point before. The bond market owns the Fed. It's not that the Fed owns the bond market. The bond market owns the Fed. They're going to follow whatever bonds are doing. So everyone's focusing on the Fed. Bonds are already telling you cuts are here. That's it.
Yeah. So and then okay. So and if that's the case, like I said, what I said back a few months ago was in I think it was October of 2023. Yeah. So that's when Chair Powell started saying things like the rise in term premium in long dated US Treasuries from July of 2023 or August 2023 till that meeting, that had been doing some of the Fed's tightening work for that. You remember that sort of thing. Well, that was kicked off by a shock lift in yield curve control from the Bank of Japan. So what he essentially said was that the Bank of Japan was doing the tightening work for the Fed. That's what that means, if that's what he's saying. Okay, so again, these are things that you have to like understand. Like, the United States market is not like the Truman Show bubble that you're just like living in. Okay, like there's a whole other outside world, right? So what I will say is that on that point, I released dollar yen 152 as a kind of the most critical, the line in the sand, or the most critical support level for global macro markets, because that this drawdown from July 11th at 11:43 a.m. Eastern time, starting from that point till what, like a week ago, or currently still, had been driven by so many factors, but the kind of the patient zero of that was the yen, was the unwinding of the yen and all that. So therefore, if we want to understand these other markets, be it the Russell, be it the Nasdaq, be it DAX index, whatever it is, we have to then therefore look at what the yen is doing to get to get any idea of how to proceed from there. And so what I said was dollar yen 152 was a key resistance or a key support level, because that was where yen interventions had capped dollar yen upside in October of 2022. And that was a very formidable resistance level for like a year and a half after that. And then it finally broke through earlier this year, and then went up to 162, and then it got slammed back down, only to be found resistance again at 152. So if you have the Nasdaq, or if you have dollar yen fall through 152, you're going to see a lot more plummeting left in kind of the like Nasdaq and other sort of risk markets. So that happened, and then subsequently that happened as well. Okay, so like right for the right reasons. I'll say what I'm wrong, right for the wrong reasons, right for the right reasons, wrong for the wrong reasons, and wrong for the right reasons. This is a case of being right for the right reasons. And what I said at the time was that it's because there is so little of the actual professionally managed capital out there that has no idea that they have no idea what they're talking about. So if they're talking about like, oh, this must be like because earnings are coming in a little bit soft and this and that. No, it's not. Okay, so there actually is an unbelievably inefficient like market opportunity if you just look at this third of the world, which is Asia, and see that things like Japan are a massive player of like what happens in U.S. equity markets and all that other people aren't seeing. That's the key thing that like a lot of capital is not seeing, and so you can front run that. That's how I was able to. The reason I was able to successfully short the Nikkei and especially NDX futures was not because of the directional call, but it was my realization that people aren't seeing this, and so therefore they're gonna flood in after me. So to advertise, if you will, the value proposition of cross spread is that there just isn't like coverage out there, especially Japan as it relates to global financial markets. And so if you'd like to join, please do so. You can follow, you can subscribe on YouTube, on Substack, and a completely subscriber sort of supported, not like beholden to other interests. So I will publish things. There's no schedule, by the way, that I publish on, because I only publish things that are related to when things happen in markets. And so you might hear from me often, and you might hear from me like over gaps of time. But everything, 100% of the things that I publish, you better open, because I wouldn't be spending time on it and wasting people's times if it weren't important. And this dollar yen 152 thing, CrowdStrike JPY thing, is a perfect real-time example of that. So that's all I'll say.
For me, the big takeaway, which I myself have said before, is that the reality, folks, is that it's all the same big fucking leverage trade. And everyone likes to think like what they're investing and trading in is something unique and special. It's all co-moving off of the same factors. Everybody, please make sure you follow Weston Nakamura, who was kind enough to do this while he's trading. And I appreciate those that are watching this here on the East Coast, given that it's now 11:22 p.m. Eastern. Thank everybody for joining. We'll hopefully do this again, maybe at the low, when the end of the world will be the bull case, in which case people will suddenly think I'm a permabull, because that's how social media is. Thank you, Weston. I appreciate it.
Thanks so much, Michael. Appreciate your work.